Greetings, members, one and all of the Salivation Nation. As I record this video with Lior Gantz, the dollar index has just broke below 100. There's a lot to talk about, not just that, but with gold and silver and central bank digital currencies. Welcome back, Lior Gantz.
Thank you for having me.
There's been a lot happening, a lot in the news with regards to geopolitics. And now we just both checked, and the dollar index is now broken below 100. It's been a long time since we've seen that. That's big for precious metals.
Absolutely. You've had a lot of data piling up regarding CPI. The last CPI that came out, it was really encouraging, really below expectations. The market's expectation relative to what the Fed will do has become very convinced that July 26th will be the last rate hike. I've looked at what's called the Fed Watch tool, which is the probabilities of more rate hikes for over 2 years now. I've never seen the probability, the two FOMC meetings out, in other words, the July meeting and then September and November, so convinced on the probabilities. In other words, usually it's 60% to the favor and then 30 to the second favor and perhaps 10% to something that's more outrageous. The July meeting right now has a 95% probability of a rate hike. So essentially, anything besides a rate hike of 25 basis points would be a huge shock to the entire market. And then there's about a 90% probability in September of a pause, and then November pause, December pause. And that is really important, because if the market is so convinced, then it starts to trade and invest accordingly. And if we are ending this rate hike cycle, and by March of 2024 we are already cutting, then that's enough certainty to start pricing in higher gold prices, higher silver prices, because of the underlying fact that if we are going to cut starting March of next year, the dollar will be weaker. So that's basically the major news here. The dollar is officially entering a cycle where market expectation for it is to weaken. There's a few reasons for it. One is what we said, the last rate hike. Secondly, the presidential elections. Both sides are going to talk about, even the Democrats are going to talk about fiscal responsibility. That's going to be very important for every American, because now with inflation becoming top of mind for everyone, part of the 2024 presidential campaign is going to be, or a big part is going to be about fiscal responsibility and what the American, what the U.S. government should do going forward. Because to borrow with 10%, with 10-year bonds trading at over 4%, it's not the same as borrowing with them at 1% or 0.5%. Imagine how much more you're paying when you issue debt to the extent that the U.S. government does. So these are big changes, and they all play into this. And of course, the big one is the fact that the BRICS nations, but I should say more predominantly the Chinese, are making real strides in getting other countries to transact in yuans, which is a major change in the world. They've already convinced the Saudis to trade in yuan for oil in select deals where the purchaser is a government agency in China. The Chinese have already convinced the Argentinians and the Brazilians to trade in yuans. And of course, it's not that hard to do that when these countries understand that Washington sanctioning them is not a far-fetched idea for anything, right? We've seen there's about 40 countries in the world that have some sort of a sanction on them by the Americans. That's a lot. That's almost 20% of the world's countries.
And that kind of leads to a discussion into the BRICS meeting coming up in August 22nd through the 24th, where a new currency will be announced for trade between these nations. But going back to the Federal Reserve, it's interesting. I've always talked about how the markets react psychologically to numbers. You know, you have essentially expectations of consumer price index and expectations of the core inflation. These numbers move a couple of a tenths of a percentage point in one direction or another, and the markets go crazy. And food costs are up, and that's not being counted in core inflation. So yes, they're good numbers, but of course these numbers are what some of us feel that they're cooking the books. But that's an aside point. You know, the markets are reacting positively to it, and of course the dollar is getting hit because of this perceived notion that they may raise rates only one more time, according to what you've just pointed out with the Fed Watch tool. Jerome Powell has been pretty adamant that his goal is 2%, and he's adamant about that, and he's been saying there's going to be 2 more hikes. So could a fraction of a percentage point in both those numbers be enough to actually change the calculus by the Federal Reserve Board?
Well, there's a lot that you said there, so let me address a few of the points because you've touched on many important ones. Let's start with that notion that, hey, does a percentage point here and there matter? 0.2%, 0.3%, 0.4% CPI to you, it's like what is that? It's a 0.1% difference. That's not much, but that's not the right way to really understand that. If expectations were that month over month or year over year should come in at 0.4%, and it came in at 0.2%, that means that in reality, inflation is half as much as expected, right? Because 0.2 is half of 0.4. And that's how the markets look at those things. They see a miss of 0.1% as a 25% miss or a 33% miss. When the Bureau of Statistics creates these, they calculate hundreds of thousands of transactions, millions of transactions, or over a quarter, or on a year-over-year basis, and that is a massive statistic. If you look at over time, and we're now at a 27-month low for the CPI, and we've been trending down for many months in a row, then yeah, it does matter. It's an important indication that the Fed's actions plus the reaction from the free market plus the way that companies have dealt with inflation and the way that consumers have acted has been constructive. But that's one part of the equation. That's not enough. What really got the markets to be convinced that the Fed will only raise one more time is the fact that the CPI came in very low, along with the jobs report that came in very healthy, because the jobs market has been the leading data set that has been disappointing. In other words, the Fed has kept raising rates, but employers and employees have not changed behavior to the extent that the Fed wanted them to do so. But the latest report showed that things are stabilizing and normalizing in the jobs market. So those two things back to back are enough to convince Wall Street and algorithms and the big money that this is a true trend, that we are stabilizing in terms of employment, which means tight labor market alongside falling inflation. And that's a very good salad to have, where you don't have spiral in salaries, and on the flip side, you don't have rising unemployment and a classical recession. And those things, meaning everyone that wants to find a job can find one, and that doesn't cause inflation, that's a good cocktail. And that's what the markets are so pleased over, and that is what is creating what's happening today. So that's one thing, right? How to look at CPI coming in below expectations, how to look at the jobs market plus the CPI, and then let's talk about what you say, which is cooking the books, or however you want to call it. Everybody knows that CPI doesn't represent the economy. and the Fed knows that as well, and Wall Street knows that as well. That's why we have more than just CPI. We have PCE, we have core goods, we have core services, we have PMI. We have so many economic indicators that the Fed looks at and that Wall Street looks at. The CPI is just a very easy tool for the market to work with, and the market just needs some sort of a barometer to work with. So it's not like everybody thinks there's no inflation out there, or that inflation is properly represented by the CPI, but it does help to understand. Now, when you look at CPI and then you also look at the problematic areas, which have been one, housing. So in other words, rents going up and up and up. We're starting to see a reversal there, or stabilization. And then if you look at what was happening up until now with salaries, we see that stabilizing. So when you marry all of this, the picture looks much better. Where does the economy still stink? So to answer the final part of your question, because you said, hey, food prices are going up. I don't understand why the NASDAQ is having its best year ever. It doesn't illustrate anything that I feel in my personal life. Why am I getting passed on again? And the reason is that 2023 is a lot like 2010 and 2011, where the Main Street economy, in other words, the mom and pop, are not feeling the recovery, and only the bigger corporations and the financial sector is seeing the benefits of the early parts of this recovery and bull market. You're at a point where, hey, we're not in a recession, but I'm not recovering. I don't see a recovery on my neck of the woods, and other people are. So that's annoying. And that's what's happening right now. So the average person and the average small business is seeing a lot of pressure. In other words, if you're Amazon right now, you can raise debt, I think, at about 6%. If you're a restaurant in your local community and you go to the regional bank, they will, if they loan you money, it will be at 20%. So it's an unfair economy, and that is the last part of this recovery that still needs to be handled. And I think that as you approach September and October, the distress level that small businesses will feel will be peaking, because I think that the regional banks will feel comfortable relaxing their capital requirements, and then the recovery will start to trickle onto a broader part of the population, and then I think you will feel better. In other words, your mortgage payment might stabilize or even start to come down again. Food prices might start to come down again, and overall, you will feel much more that you're part of this stabilization of the inflationary story, and then of the economy in general, because the United States economy right now is seeing some incredible benefits from what's happening around the world. And so to me, the last hurdle here is the regional banking sector, which is just afraid to do banking right now, and that's hurting mom and pop, and then housing. So those two are the last two hurdles for us to have a really broad recovery and start to see better days.
And through this, gold and silver are reacting positively early here, mainly because of what the Federal Reserve may not do, which is raise rates one more time this year. And so we may have an extended pause and maybe a pivot into 2024. So let's talk about your thoughts on gold and silver. First, gold.
Gold has been very resilient. I think that has to do with the fact that gold is not just traded by retail investors and small speculators. It is traded by governments and central banks. As you know, 2022 was the record year for central bank purchases. They've never purchased more tons of gold in one calendar year than in 2022. That has to do with, one, the weaponization of the dollar, which has acted against the central banks. If you go to wealthresearchgroup.com/USA, it's a report that I did on the ground where I am at in the Middle East and how the United States actions in the Middle East have shaped this sanction economy. And if you also download wealthresearchgroup.com/petro and /Saudi, that will tie in to how we are seeing the end of the modern day petrodollar, because that's what's happening right now. And if you ask me why is gold so resilient, it's because the role of the dollar as reserve currency is diminishing. We first saw it with the BIS announcing in April 1st, 2019, that gold is going to become a tier 1 asset. That was the first part of this. And of course, that came after Trump's UN speech that every country must now contribute 2% of GDP to NATO for the defense. And the whole construct of we are the United States Navy, we will patrol the oceans and the waters and protect our allies so that the Saudis can sell you reliable and cheap oil. We will buy it from them in US dollars. In other words, the petrodollar system came into question for the first time during the Trump years. And of course, Trump knew what he was doing. This is not new. Obama was actually the first to say in 2011 that after the shale revolution, I don't think we need to rely on the Saudis as much as before, and we can take our military budget and focus it on the South China Sea, where our new adversaries are rising to challenge our hegemony of the world, are emerging. So this move from the Middle East to China, this move of focus, has been enabled by the shale revolution, which made America independent in terms of oil and natural gas. And then, obviously, in the years of Trump, where anti-globalization became even more popular, he then said, look, we're done being the policeman of the world because it's creating unsustainable budget deficits on our end. And so we are pulling out. And in that vacuum, we expect you, each country, each respective country, to start militarizing and control your own borders and protect yourselves. And we're seeing that. Japan, which has been a pacifistic country for decades now, has embarked upon its largest ever military program for 5 years. Germany has, I think, 100 billion invested in military upgrades for the next 5 years. Japan, I think it's like 300 and something billion. It's a huge military program. And of course, the United States continues to expand its military. And the reason is because the Chinese are building the equivalent of an entire British Navy fleet every 2-3 years. They are on a massive military expansion. And so this world that we are now living in, where there's a new Cold War, so to speak, or two adversaries that are fighting each other, is not something that we've seen since 1991, when the Soviet Union collapsed. We became a world of one power. For the next 30 years, from 1991 and up until the pandemic, we were in hyperglobalization. Hyperglobalization meant that the Soviet Union was no longer a threat. Their commodities were cheap and they flooded the markets, so we could build more, we could innovate more with the rise of the internet, and inflation wasn't a problem because here oil was cheap, everything was cheap, commodities were cheap, resources were cheap, and there was a lot of trust between countries. And that backfired. Starting in the early 2000s, globalization should have peaked in 1991. In other words, the petrodollar had no reason to exist after 1991. Why would any American voter continue to vote to put our earned tax dollars into defense when there's nothing to defend? You beat the biggest enemy that you had. But of course, the neocons and the globalists continued on their agenda, and it backfired on them. in the early 2000s, and then with Iraq and Afghanistan, etc. And all these soldiers were saying, "What are we doing? And who are we fighting? Who's the enemy?" And now, you're past that. The world is now peaked in globalization, and therefore, in this multipolar world that we now live in, where you have the BRICS, you have America and Europe, you have or NATO and the BRICS, etc. Now the role of the U.S. dollar is becoming diminished. So in the next few years, as the dollar continues to weaken, I expect precious metals to do very well, especially silver, though. So, to me, silver is going to outperform the returns of gold in the foreseeable 3 to 5 years as this bull market continues, or as the bear market in the dollar continues.
That's great, and I feel the same way, especially as the industrial aspects of silver, I think, are going to probably start to shine fairly soon, pun intended. Last topic here. There's an article here from Reuters that talks a little bit about central bank digital currencies and how there are 24 central banks that say, according to a survey, that they will have digital currencies by 2030. And in this survey, about 93% that of central banks say that they are engaged in some form of central bank digital currency studies, and they are going to be accelerating their work in the coming years. So it looks like it's coming. And what are your thoughts about that?
I really urge you to download the 2 reports that we put out on CBDCs, which explain everything that all central banks are doing around the world right now. You'll know everything about CBDCs if you read those. They're about a 10-minute read each, and you will literally be up on everything. It took me hours of combing through BIS, IMF, central bank notes, programs, etc., and I condensed them for you. So just go to wealthresearchgroup.com/CBDC. And the second one is /CBDC2, the number 2. And I assure you, you will know a lot about what's going on in the world of CBDCs. Along with those 2, I want to give you fresh updates that are now happening. So, as you said, the prospects of central banks rolling out CBDCs has increased dramatically in the last 2 months. This is something that out of nowhere became a really important topic for central banks, a really important project for many central banks. CBDCs are divided into 2. There's wholesale CBDCs and there's retail CBDCs. Wholesale CBDCs are central bank digital currencies that are issued by the central bank for them to use in transactions with other central banks or with commercial banks. In other words, these are coins that don't go into circulation for the general population. It won't matter to you. It will change nothing to you. It's just the central banks discontinuing or moving some of their transactions from the SWIFT system or from traditional clearing systems into a new system that might be faster, more reliable, more secure. For whatever reason, they're going to transact amongst themselves that way. Maybe it's on a blockchain, or it gives more visibility to central banks on what other central banks are doing. It's just something that's between them. The retail CBDCs are what most freedom-loving individuals concern, because that is where they think that abuse of power, not by the central bank, but more by the government, applying some sort of a either control or measures of privacy or loss of privacy, measures of sanctions. In other words, if they see a citizen, this is more, I'm talking about more China, but it could happen obviously in other countries as well, where a person does not behave a certain way and his account gets frozen or seized or halted or whatever. We have not seen any central bank that's ready to roll out a retail CBDC. Those that are further along will roll them out very slowly. In other words, they will replace 2, 3, 4, 5% of the currency in circulation. So not something that would really impact you. And third, no central bank has become convinced that it's worth the risk to go fully digital or cashless. And so this will always accompany, or not always, but in all the existing papers and studies, the central banks continue to see a lot of advantages to having physical paper currency. Wherever you will start seeing retail CBDCs, they will come at a very small scale after months-long pilot programs that will probably focus on making sure that these are secure from a cyber perspective, so that other hackers can't come in and destroy a currency system. Could you imagine if that could be a war that a country wages on another country? They can mess with their currency system, or just conventional activity of theft could occur as well. And secondly, there's an issue of interoperability. In other words, if I'm a Venezuelan or an African and I can now access a CBDC issued by the Central Bank of the United States, in about 10 minutes there will be no more other currencies in Venezuela. They will all use the US dollar because it's obviously the most stable fiat currency. And so you would have a nation that de facto the free market has elected to take control of US issued CBDCs, and that's not the point. That's not the goal of that a nation would now become a dollar nation. There's that issue as well of how do you distribute a CBDC and keep it in the hands of only your citizens, or how do you not turn another country into a country that now deals with your currency because it's the more stable. So there's that. The challenge that the central bank has is that currency, as you know, is as important as water or air. Like it's an essential part of our lives as advanced societies, and we can't risk rolling out a CBDC in the wrong way. So it's something that to take the time to do it right, even if it takes years, is something that they're willing to do. On the flip side, they don't want to take too long because no government that I know of, and no central bank that I know of, want the decentralized forms of currency to take hold in society, where either Bitcoin or altcoins that are stored on mostly on exchanges would become important in society, and you will have basically a society with quasi-banking institution, private companies controlling the currency supply. So that in an insufficient regulatory environment. So they are facing that challenge, that they must act fast because the world is evolving, and of course in the future, in 2 or 3 decades, I assume that most currency will be digital.
Thank you for your thoughts on that, Lior. And that's about all the time we have. Do you have any closing remarks before we go?
I think that if you want to also understand kind of the way that it's essential now to build a portfolio that suits this environment that we're entering in, I've created a PDF version of my own portfolio that you can access for free. If you want to download literally my own portfolio, go to wealthresearchgroup.com/portfolio, and you can see exactly what I am investing in.
Thank you for that. And I'll post a link to wealthresearchgroup.com in the description below. And maybe Lior will send me the links to the other URLs he's posted here. But if anything, just go back through, and as he lists them, you can just put in the codes there that he gives beyond the /. Thank you again, Mr. Gantz. Appreciate your time here. And I want to extend a multitude of gratitude to each and every one of you for taking the time to watch, and encourage you to please rate, share, comment, and subscribe.